So this comes to you from rather chilly Vermont this morning. This is the Chapter 11 on corporations, and there's a few of the, you have to know a lot of the terminology and the characteristics of a corporation in order to make the journal entries, and that's why we take the time to go through all of these. So the first thing is the corporation is a separate legal entity. You've got partnerships and proprietorships and corporations are all separate economic entities. They all keep their own set of books, and they keep their activities separate from the activities of the owners. But a corporation, in addition to that, is a separate legal entity, which means that it has its own taxpayer ID number, and it can act as a unit of in apart from its owners. So a corporation can buy and sell property, it can hire and fire employees, and file its own tax returns. Partnership and proprietorship returns, income tax returns, flow through the owner's tax returns. You get publicly traded corporations, and those are the ones we're going to be doing the journal entries for. They sell their shares of stock on the open market, New York Stock Exchange and others. And you generally think of them as large companies like Apple, Microsoft, and so forth. There's also privately held corporations, and these trade shares within a small number of investors or owners. My construction company, privately held, 3 stockholders, we ran the whole deal, and we didn't trade the shares. But privately held corporations can also be very large. Your Cargill is the largest. They're a food, drink, tobacco. They've got $135 billion in revenues, more than AT&T. And then there's others that, they have billions in revenues, but they are privately held. And all that means is their stock is not traded. To set up a corporation, it's a little more involved than setting up a proprietorship. Partnership, you do have to have your agreements drawn up. But the incorporation papers, generally drawn up by a lawyer and filed with the Secretary of State in the state where the business resides. The Secretary of State approves the charter, and in the charter, which is also your articles of incorporation, it tells how many shares the corporation can issue if it wants to. These are the number of shares authorized. And when we're doing the journal entries and reporting for this section, you have to be aware of what it means to say shares authorized, as opposed to shares issued and outstanding. Okay, another characteristic of a corporation, limited liability. This is in contrast to proprietorships and partnerships. Many companies, small companies, incorporate just for this characteristic. Because say you have the banana peel, the customer slips on a banana peel and you're a proprietorship, that customer can sue the business, but they can also come after your personal house, your personal car, your other personal assets. If you're a corporation, same banana peel, same slip, they can only come after the corporate assets. They cannot come after your personal assets. So limited liability, a good thing. Ability to raise capital. If a corporation wants to raise capital, it can sell stock. Partnerships and proprietorships can't. That's the main difference right there. Partnerships, proprietorships generally would go borrow from a bank or other lenders. This is all changing somewhat with GoFundMe, and the Securities and Exchange Commission is getting involved in some of that now. But in general, the corporations have a huge ability to raise capital because they can issue shares of stock on the stock markets. Transfer of ownership of shares. Each share of stock, when you buy a share of stock, you get a vote, and you're considered to be an owner of the corporation, and you own the percentage of the shares of stock that you own. So these shares, publicly traded, they can be traded back and forth amongst the various owners on the stock exchanges, and transfer of ownership for partnership and proprietorship is a little bit more complicated because you have to draw up legal documents rather than just sell your shares. Okay, I think continuous existence, you can get that one just by reading. And corporate management, same thing. Government regulations, I would like to talk a little bit about. The text lists government regulation as a disadvantage of being a corporation. Okay, some of the regulations apply to all businesses, not just corporations. Environmental protection laws apply to all companies. OSHA, the FTC, Federal Trade Commission, the ICC, Interstate Commerce Commission. But then there are some regulations that apply specifically to corporations, and these are the regulations from the Securities and Exchange Commission, and now the Public Company Accounting Oversight Board, PCAOB. You have to remember that both of these agencies were started as a result of huge corporate scandals and disasters. Okay, the SEC came into existence after the Great Depression, the financial debacle of that. The PCAOB is part of Sarbanes-Oxley legislation, which came after the previous meltdown, not 2008, but the one before that. So there's a reason for some of these. So now, in my notes, I say personal opinion alert. Before you think regulations are a disadvantage, I'd like to think about yourself and your boss, okay? How many hours would your boss have you working if there were not labor laws? What age would you have had to start working? And then think about driving to Mass Bay and back, okay? Do you want to be out on the highway with truckers who are overloaded in terms of the weight they're carrying, haven't slept for, 72 hours, and are driving at 130 miles an hour? Okay, some regulations are not necessarily a bad thing. There's a lot of press that says all regulation is bad. I'd just like you to sort of think about that a little bit and think about what it really means. Okay, and I think that's all I'm going to do on this podcast. I'll get to the stockholder rights in the next one.